Well, it's on that note now that we turn to the day's business news, and we're going to start with the make or break week for the French government's pension reform plans. To tell us a bit more about their and possible concessions that may be put on the table, we're joined by Cole Stangler. Cole.
That's right, Eve. Strikes are continuing today ahead of another major national walkout scheduled for tomorrow. Now, on Wednesday, Prime Minister Edouard Philippe is then expected to formally introduce a proposal. He'll be aiming to keep the government's reform ambitions intact, all the while winning support from the public and labor unions. A very difficult balancing act, and one that could involve concessions. One option could be to delay the application of the new retirement law, now slated for 2025, pushing back the first generation of retirees to be affected by the new universal system. Another could be to delay the law for some groups of workers, pushing back the phase-out date for one or several of France's 42 different pension schemes, as you can see here. Another even bolder option would be the so-called grandfather clause, applying the new law only to workers starting their careers in 2025. But even that could be tricky, with some in organized labor already ruling it out. Take a listen.
We're not in the habit of sacrificing future generations. That's not our demand. We are not on board with the grandfather clause that sacrifices our children.
Now, unions are scheduled to meet with top government officials later today. We'll see what comes of that. Let's take a look now in the meantime at Monday's trading action. Shares are down on the major European indices to kick off the week. FTSE down just slightly, nearing 0.5% there. Losses on the CAC 40 as well as on the DAX over in Frankfurt. Let's turn now to the major Asian indices, which did see some gains earlier. The Nikkei up around 1/3%, as you can see slightly here, turning to the Asian market soon. Nikkei up around 1/3%. The Hang Seng over in Hong Kong slightly flat with some very minor gain. Shares in the Shanghai Stock Exchange also posting some slight gains just above the flat line. However, they were down earlier in the day. Now, one of the reasons for those losses in China earlier were some disappointing economic figures. Exports from China fell for the fourth straight month, according to the government, dropping 1.1% in November when compared to the same month last year. Fell well short of the 1% increase that analysts were expecting, and highlights the high cost of the country's trade war with the United States. Two are still aiming to reach a deal to avoid further tariffs taking effect on December 15th. Now, these days, Washington is well accustomed to trade tension. The U.S. is currently weighing whether to impose tariffs against France on products like wine, cheese, and luxury goods. It's in response to France's digital tax, a 3% duty on major online firms, including Google, Apple, and Facebook. On Sunday, France's finance minister criticized the U.S. for considering retaliation, saying Paris could take its case to the World Trade Organization.
We believe these sanctions have no legal grounds. When the U.S. claim American businesses are being discriminated against, and that's why they're imposing sanctions on us, I disagree. We're ready to go to international justice at the World Trade Organization, because this digital tax doesn't only affect American businesses, it also affects European businesses, French and Chinese businesses. So it's absolutely not discriminatory.
Meanwhile, in the United States, a trial that could shape the future of the country's wireless telecom sector is kicking off Monday. Lawyers for T-Mobile and Sprint will defend the company's $26.5 billion merger in court. It's already won the support of the Justice Department and the federal telecom regulator. But a group of states is suing, saying the federal government got it wrong. Attorneys for New York and California say the merger is a violation of antitrust law and will lead to higher prices for consumers. And finally, another warning about how climate change will transform the global economy. According to a report from the UN-backed Principles for Responsible Investment, carbon-intensive companies stand to lose 43% of their value in coming years because of policies designed to fight climate change, with coal, oil, and gas companies to suffer the most. On the other hand, the report says there will be some winners. Automakers that transition quickly to electric vehicles are expected to more than double in value. It's a speculative report, Eve, but still part of growing interest in the business world about the high cost of climate change.
And so much of it comes down to money. Cole Stangler, thanks a lot for that business update.